Hey everybody, it's Julia here from Welcome Home with Julia, and I have Hannah from Mortgages with Hannah. And we decided to hop on because I've been getting a lot of calls from clients that are distressed from their life payments, a lot of that having to do with their mortgages increasing due to these interest rate hikes. And I wanted to look for options. So Hannah has provided me with some, so I thought we'd hop on and share them. So Hannah?
Over to me. And yeah, I hear you, Julia. It's the number one call we're getting right now is clients struggling, whether they're in a variable rate mortgage or a fixed rate mortgage, and just everything's gone up, right? So we heard Benjamin Tal speak yesterday with the CIBC economic update, and he provided some insight into what's happening. And one thing he did recommend was he loves the variable rate mortgage, and he's still riding the variable rate wave along with a lot of mortgage agents, a lot of us in the industry. But if people are losing sleep, as you said, like if you're worrying about the next Bank of Canada meeting or the one that just happened, maybe now's the time for plan B and sitting in a 1, 2, or 3 year fixed rate. The problem is the banks put up the 1 and 2 year fixed rates. So they're well over 6% now, of course, right? So the 3 year seems to be the option for a lot of clients. And here's our most common calls right now. So clients that have a high balance on their home equity line of credit. So that secured line of credit sitting at prime plus 0.5% or prime plus 1%. Now with this latest meeting puts us at 7.2 or 7.7%. Yeah, that's painful just saying that. So the 3 year fixed right now, 5.29, 5.34, you could be saving well over 2%. We amortize that over 30 years. We get the payments under control and the debt under control. And we keep in touch for the next 3 years. We keep an eye on rates and we continue the conversation, but that's the solution for now, right? The second thing we're seeing a lot of is clients in the variable rate mortgage. I mean, last March, we were at 2.45. We have gone up a lot, and perhaps one more increase in March. Benjamin did say yesterday, once we get to the top, we may pause for a year and then sharply come down within 6 months. But how much more can most Canadians take, right? So we're at that breaking point. So those clients sitting in the variable rate mortgage, now might be the time to call your bank and see what they're offering for lock-in, and then email or call me and I'll tell you if that's a good deal or not. I often tell my clients, name drop, say, thank you for your quote. I'm going to call my mortgage agent. And as soon as you do that, you make sure you're getting the best rate, first of all. Second of all, I'm going to check my top 20 lenders and make sure that's a competitive rate. We have, me, of course, I have a spreadsheet calculator for this. We have a spreadsheet calculator that say, if we leave that lender and pay X amount of penalty because we can get a better fixed rate over here, is that worth it? And we'll show you all your options so you can make a decision based on facts, not based on fear. It's really hard in this market not to make a decision based on fear, but I'm all numbers and I'll show you all your options, right? So perhaps if we're in the variable rate payment, we're locking in with our current lender or locking in with a new lender at a 3 year fixed rate, getting that rate down and those payments under control. Another thing we're seeing is clients coming up for renewal. So they're in a 3 or 5 year term. Their rate perhaps was 3%. Now they're getting the renewal offer from the bank at 5 or 6%. Never, ever, ever sign the lock-in agreement without talking to someone, first of all, or the renewal agreement ever. But another problem we're seeing with that is they've paid down their amortization. They're not at 30 or 25 years anymore. They're at 20. So that payment is inflated because they only have 20 years left on their mortgage, and then add in the 5 or 6% rates. So what we're doing with those clients is taking them to a new lender and re-amortizing them over 30 years. I know I'm in the industry and we were kind of talking about this. I don't see a lot of mortgage-free people at retirement anymore. It's not a thing. So our goal right now is to keep our house and manage everything else that's gone up. Like we were saying, gas, groceries, everything has gone up. So let's make that mortgage payment manageable so we can keep the roof over our family's head, right? So re-amortizing to 30 years is something we're offering there. And then the last thing we're seeing a lot of right now is our clients who get to 55 years old and are planning their retirement and still have a mortgage and perhaps have elderly children living at home and car payments and all these things just piling up around them, they're not eligible for reverse mortgage. So no mortgage payments, access the equity in their home tax-free. Perhaps we can make a plan for them to go on holiday. Perhaps we can make a plan for them to draw some income from the equity in their home. We have lots of options, lots of options. It all really just starts with a call. But if anybody is feeling the burn or you know, seeing, aligning with anything I've just said, then I'm happy to help. Yeah.
Well, thank you, Hannah. So hopefully that's helped some of you out there. If you guys want to reach out to Hannah, we'll have her contact information summarized down below. And yeah, thank you so much.
Thanks for having me, Julia.
Take care.